A massive new free trade agreement is merging India's 1.4 billion citizens with the European Union's 450 million. For the average consumer and professional, this raises immediate questions. Will European imports become significantly cheaper? And will it be easier to secure work visas for the 27-nation bloc? We are looking past the headlines to see how these specific tariff drops will directly impact your wallet and your career path. This agreement links two economies that together account for 1/3 of global trade, creating a massive new trading corridor. This chart shows the current trade volume between India and the EU, which currently sits at 120 billion euros annually. Projections show this baseline absorbing an additional $30 billion in trade over the next few years as barriers fall. To drive that growth, the EU is dropping import duties to zero on 99.5% of all Indian exports. India is reciprocating by reducing tariffs on 97.5% of European goods entering the country. This pie chart illustrates the scale. The combined bloc now accounts for 1/4 of global GDP. These tariff cuts will elevate the EU to India's third-largest trading partner, physically increasing the volume of cargo flowing through these ports. For Indian consumers, slashed customs duties will lead to lower prices on high-end European imports, starting with luxury vehicles. Those price reductions extend to premium goods like European wines and the advanced industrial machinery used to upgrade Indian factories. On the industrial side, the deal targets labor-intensive sectors that are essential for large-scale job creation. Because $33 billion worth of exports, including textiles, leather, and jewelry, will enter the EU duty-free, manufacturers are expecting a substantial expansion of the domestic workforce. The agreement also aims to ease the visa process for the service sector, facilitating more opportunities for Indian IT professionals, doctors, and engineers to work across Europe. This zero-tariff access to Europe provides the capital needed to set up more local factories, supporting the ongoing growth of the Indian manufacturing sector. However, there are significant exclusions. To protect local livelihoods, India has kept its sensitive dairy and agriculture sectors entirely out of the agreement. Indian exporters also face the EU's Carbon Border Adjustment Mechanism. This flowchart shows how manufacturers of materials like steel and cement will pay a heavy tax penalty if their production exceeds strict emission limits. Exporters will also need to comply with rigorous European labor laws and intellectual property standards. While the market is larger, the financial cost of upgrading to these standards will be a major challenge for smaller Indian businesses. More broadly, this partnership supports the China Plus One strategy, positioning India as a primary alternative manufacturing hub for European companies. To remain competitive, Indian suppliers must focus on meeting these higher international manufacturing and environmental standards. If these industries can scale to meet European requirements, this trade pact will serve as a primary catalyst in India's drive toward a $5 trillion economy.